Hello everybody, welcome to today's video. It's a Patreon Q&A, the March Q&A, and I'm gonna answer specifically 5 questions that came from my Patreon today. The first question is, can we beat the denominator with Chinese stocks? And as a reminder, when I say beat the denominator, I mean 15%. That is 15% a year. That is the speed at which the money is debasing, in my view. So if you just want to save, if you want no return, slightly beating the denominator will do it. The goal of this channel is to 2x the denominator, i.e. achieving 15% real return. That would be 30% nominal return in dollar return. And so the question is, Chinese stocks, European stocks, can you beat the denominator? The answer to that is yes, you can beat it. You can beat it slightly. I just use a few companies that were just on my mind. This is Hermes. You can see Hermes bought the denominator. QQQ, the Nasdaq was 17%. So it bought the Nasdaq, it bought the 15% of the denominator, did 21%. SAP did over the longer run, over a 26-year period, they did too, but barely. S&P barely beat it, and you gotta ask yourself how much of that S&P beating of a denominator has something to do with the past 2 years for S&P, which have been absolutely amazing. Novo did handsomely beat the denominator. Pinjojo slightly beat the denominator at 15.5. And by the way, S&P did not beat the denominator. It beat the Nasdaq. And the Nasdaq, when you include the 2000s in the Nasdaq, you find out that it doesn't beat the denominator. So how much diversity do you really get if you look at Chinese stocks and European stocks? The answer to that is I don't think you get as much diversity. And because you don't have as many stocks, not as much diversity. And this will become very clear when I show you the map of market caps. The map's right here. You can pause the video and look at the map, and you can see it's a sea of US stocks, and trying to spot the European or Chinese stocks is kind of like a game. I tried to spot them. Thank goodness for TSMC showing up, but it's kind of like very tough to spot the non-American stocks when you look at all of the market caps together in a chart, in a perceptual map. Anyways, the point is, if you invest in EU or China, you got to be much better at stock picking because there's fewer stocks that beat the denominator. Point number 1. Point number 2, cultural barriers, language barriers may make it tough to understand the business. For example, how do I deeply investigate a business in China? You know, it would be much tougher, right? There's simple stuff like food, for example, Luckin Coffee. I've talked about Luckin Coffee on this channel. Food is fairly easy to understand, but could I invest in the Chinese hims and hers? Would that be something I would understand? No, I don't think so. EU may be less of a language slash cultural barrier, but still some barrier in investing in those markets, of course, unless you invest in your own country. Like I wouldn't have a problem investing in a French company if I could actually find one that I found compelling, which I have not. A number of folks don't want to touch China stocks because of accounting, and so you're never going to have the valuations, I think, that you see in the USA, because you will always have a lot of very big investors who are like, no way, I'm never touching China ever. And I think a lot of Europeans themselves, a lot of European investors actually prefer USA stocks because the USA stocks are really USA companies that are world companies, right? McDonald's is as popular in Europe as it is in the US. In fact, McDonald's, I would argue, is more popular in Europe than it is in the US, because in the US you have all sorts of fast foods, and in Europe McDonald's is still number 1, right? And you could argue, KFC is likely much more popular in Japan than it is in the US. And so a lot of US brands are really international brands. If you look at the United States in 2024, that was really 60% of the world's market. 60% of the world's stocks. So think about it. The US is about 4% of the world population. It's 60% of the world stock. The second biggest was Japan. The third was the United Kingdom. So kudos to Japan and the UK to be in the top 3. But nonetheless, the US is where all of the stocks are at. I think there's also some of the issues there's 2 issues. One of them is the dollar. A lot of people want exposure to the dollar. If you buy a US stock, you buy a dollar derivative, you get exposure to the dollar. And so a lot of people are like, okay, I'm going to buy just a US index. That way, not only do I benefit from the US stocks going up and the US economy doing its wonder, but I also benefit from my country's currency devaluing against the dollar. And if you look at most currencies against the dollar over a very long-term period, they just lose a bunch of value against the dollar. It's crazy to think that the dollar is actually the cleanest sheet in the laundry, but it is the cleanest sheet in the laundry. And so, for example, if you're in Turkey, it might be a really good idea to just buy an index fund, partially because you want exposure to the dollar, and you also want exposure to what I call the index gravity or the index black hole, which is what we owe to Jack Buckle, which we just now have people who buy index funds, who buy the QQQ, who buy the NASDAQ, just because it's as if they were buying gold or as if they were buying Bitcoin or buying real estate. It's a bucket. They call that bucket the securities bucket, and they just put money in the bucket, and that increases the valuations. Another question and this is more true for Chinese stocks than for EU stocks, but how many of these EU, Chinese, foreign stocks are actually on your broker's rails, right? You can't get all stocks with all brokers. That's the unfortunate part about not living in a blockchain world, in a crypto world. And so that's one of the big questions. I'll conclude with this, showing you this is the world market. So this is on Finviz, and you can have all of the stocks in the world that you can access within the US. So you'll notice some companies are not there, for example, like some ADRs are not there, for example, but the main ones are there. So you can spot TSMC, you can spot SAP, right? SAP, one of the largest companies in Europe. TSM, obviously one of the largest companies in the world, and definitely the largest company in Asia. You can spot Baba, you can spot Pinduoduo, you can spot Toyota, you can spot Ferrari, and then, there's like a huge company, for example, Saudi Aramco, right? Saudi Aramco would probably be the size of Apple, but Saudi Aramco is not showing up on his map. How do you invest in Saudi Aramco, either in Europe or in China? And it would show up on the gas thing. So even then, it's just tough to access. The U.S. market makes it so easy to invest, so easy to access, so easy to view these opportunities, and that's why I think a lot of the funds from the entire world just go to the U.S. and invest in the U.S. They want dollar exposure, they want exposure to the index gravity, and people just buying the index, and they want exposure to world companies, and that's why I mostly cover U.S. stocks. But if I see an opportunity in Europe or in China, you bet I will cover it. Moving on to Enphase. When am I planning to reopen my position in Enphase? Yes, I want to reopen Enphase, but I need clarity on the IRA. Now that I'm out, now that I took my loss in the mid-70s, now I'm like, I have a bunch of time to get back in. So I need to see compelling things to get back in. I already took the loss. It's not like I'm in and I'm trying to justify staying in. It's too late. I'm out. So now I think actually Musk being I was going to say in power. He's not in power, but being a big helper for the Doge of the government means that he's close to the president. So, and obviously Musk does not, I'm going to go ahead and say does not want the IRA subsidies to be gone. Manufacturing subsidies for batteries is one big thing. There's a debate as to whether he wants the $7,500 tax credit to be gone. That's on the demand side, not on the supply side. Benefits to Enphase of IRA are in my view, still mostly on the supply side. It's the pennies, the 12 cents per watt peak that they get on each inverter that they make. That's on the supply side. That's the subsidies towards manufacturing. I don't think Trump also wants to end manufacturing in the US, so it's kind of a double-edged sword. I'm waiting to see some clarity as to what's going to be left on the IRA and what's going to be stripped out of the IRA. I don't think it's going to just blanket erase the IRA. I think it's going to be more nuanced than that. I think we probably have another year to go before we find, hopefully less, before we find out the clarity. The Powerwall. Is the Powerwall a threat to Enphase, right? When I exited the stock, that was the main debate. Powerwall is going to kill Enphase. I would argue if what people say about people not buying Teslas because of Elon Musk, wouldn't it stand to reason that people are not going to buy Powerwalls because of Elon Musk either, and they don't want to see Tesla inside the walls of their garage? You see, this is where this argument makes very little sense. I don't think people make decisions based on vanity or on how people feel about them. I think they just buy the best solution. I think people sit down, they look at 10 different cars, and they buy the best car. And I think it's the same for the Powerwalls, even though they may have to display an electrical equipment outside of their house. I don't think their neighbors will be mad at them. And so, it all depends. We'll see. Is the Powerwall a threat to Enphase? That's another big discussion. So Enphase has two discussions right now. Is Powerwall a threat? Discussion one. Are the IRA supply side subsidies going to go away? Discussion number two. So medium term, some uncertainty, which is why I'm not jumping back in right now. But over the long run, I have no doubt in my mind that electric cars and solar are the future. They make the most sense over the long run. They are the cheapest way to get around and the cheapest way to get electricity. So over the long run, I still think Enphase is going to be just fine. If I were to get back into Enphase, I would get it back via January 2027 leaps. And hopefully the summer leaps hopefully are still out. Maybe 2028 would be an even better leap. That would be how I would get out. The volatility on Enphase is actually not, I mean, it's high, but it's not nearly as high as it used to be, which means that the leaps are a little cheaper. So that's how I would get back. For now, I am not back. I will make a video on Enphase soon as I get more time to do that. Moving on to Bitcoin. Let's go. So Bitcoin. So this is I mentioned in my other video which Bitcoin ETF I was using, and this Patreon member, thank you for your support, asks me which Bitcoin ETF, I think is best. Well, first of all, let me just say disclaimer, no investment advice, of course, this whole video, nothing I say is investment advice, but even Bitcoin, for Bitcoin, I'm an old Bitcoiner, you gotta realize. And so for me, pure form is still the first, like pure form first is still what the old Bitcoiner in me is telling me to say. Get some pure form. No financial advice. Cold wallet. That's what it means, right? And why am I confident with that? Why haven't I moved any of my cold wallet Bitcoin to ETFs, like many people have already? Why haven't I done that? Because I believe we'll have safe blockchain rails at some point to be able to borrow against it. One of the innovations I really look forward to is a Bitcoin-based blockchain where you just pledge some Bitcoin and then you can get a mortgage based on the Bitcoin that you pledged. Imagine how that would change entirely the game for mortgages. So anyways, I think we're going to have, ways to quote-unquote exploit pure form Bitcoin in the future, but right now it's a cold wallet, it's dusty, and it's just what it is. That's point number one. Then for the ETFs, right? I've added to Bitcoin recently. So for the ETFs, why would people want to get the ETFs? Theoretically, there's less security risks. You're protected against yourself, right? If you get a handicap, if you have a car accident, if you have a mental disability, you lose your mind, something like that, something can happen. You may lose access to the pure form, or your family may lose access to the pure form. So there's less security risks theoretically. That's the theory, though. This has not stood the test of time. I think they're safe. I think ETFs are perfectly safe, but that's no financial advice. The main point for me to own ETF is the margin. It helps towards your margin, and I want to have a pristine margin, because if there's a dump in the market like 2020, I think it would be very helpful to have a pristine margin at that point. And so if I'm going to add something to the portfolio, it has to help my margin. And given that I want to own more Bitcoin via the form of ETF, and given that I already own pure form Bitcoin, the question is, which ETF helps the most with my margin? That's my goal. And the ETF that helps the most with my margin, believe it or not, is not GBTC. Forget about GBTC. The fees are just too high. It is the Grayscale Bitcoin Mini Trust, which was a spin-off of GBTC, which has fees that are actually slightly lower than the iShares Bitcoin Trust, which is the main one. And the maintenance requirement is 25% versus 30%. So actually, that makes a difference on margin. That makes big enough of a difference for me to choose this one as opposed to this one, because I don't plan to write options on my Bitcoin ETF. Now, it depends what your goal is. If your goal is to enhance your margin, I like this one the best. And it depends on your broker. Your broker may give you no margin whatsoever on this Bitcoin ETF. So it depends on your broker. This is Robinhood. Okay. So that's for me. That's my goal. If your goal is to write options, then IBIT is obviously the best, because you get the best volume. You get everything the best with IBIT. So if your goal is to write options, if your goal is to be able to transfer it easily to lesser known brokers, for example, everybody's going to list IBIT. So that's the best option in that case. And lastly, if your goal is to support quote unquote good firms, and this was especially important in the early days of the ETFs and the early days of crypto. You had people who were like, okay, well, the ETF just launched, let's support the people who supported the ecosystem. Some people are choosing Cathie Wood's ARK-B or Fidelity's FBTC because they're like, okay, I want to do a pro-Bitcoin behavior and support the firms that have not fought against Bitcoin in the past, but that have fought in favor of Bitcoin in the past. So it depends on your goal. This one fits my goal the most. So hopefully that answers your question. Then I have an easy question. LifeMD. So let's go back and talk to LifeMD. The question is, at what level do I still consider LifeMD a buy? And I thought long about this, and to me it's about $12. So that wouldn't quite be price discovery because we spiked close to 30 during the frenzy of February 2021, but that would be, I'm gonna call it pseudo price discovery as soon as we reach the $12 mark. I would be interested up to the $12 levels. Why is that? Because if it traded at $12, it would put LifeMD's enterprise value over gross profit over revenue growth at about a 0.1, and without WorkSimpli, and again this is a speculation as to what WorkSimpli would be worth if it was sold off, the LifeMD stock then would be at a 0.05. So it would still be cheap. It would still be slightly cheaper than HIMS. I still think HIMS is the bigger company in the space, the better company in the space. But nonetheless, I would still be interested up to $12, and I think it's especially a good deal under 8. But as always, this is not financial advice. This is just what I do. This is just my views. And the last question is about Elon Musk. As Musk becomes more political slash MAGA, am I concerned about my Tesla stock? And the answer to that, as you know, is no. And my viewers know this, but you're probably asking me more detail as to why it's a no. I think it's all about the news cycle. I think right now the news cycle is about hating on Elon Musk and Tesla, and so that's what we're going to report on. I always say, I remember the days vividly when it was BP who was in the news cycle, and of course people were boycotting BP gas stations because of the oil spill in the Gulf. That lasted 18 months, and then BP became crazy again, and people shopped at BP and not cared about the brand anymore. I think over the long term, that's what's going to happen. Over the short term, of course, maybe it's different. Even that, I'm not so sure, because frankly, there's money on both sides. There's money to buy cars on both sides, and so if one side of the aisle doesn't want to buy the cars, then you have, conservative anchors like Sean Hannity who are like promoting Tesla on their news show on Fox News. So I think you may have a lot of conservatives buy the car, and there's money on that camp too that could buy the car. So that's another point. I remember the news cycle once again. They did the same thing when he bought X in April of 2022. You may remember that. That was a big conversation that lasted 6 months, and then people got used to it. They got used to Musk owning X. I think they're gonna get used to Musk being in the efficiency department. And next thing you know, he said he had another 1 year. Next thing you know, he's not gonna be on there anymore. So the stock will rebound. Again, this is a problem if you're into short-term options, into short-term instruments. If you're investing for past 2030, this is not going to be a problem. He's not gonna be in the news spotlight forever. He's not gonna have that job forever. And even then, I would say the MAGA, right? The current administration is not gonna be there forever either. Like, we're investing for a longer term horizon than a 4-year term horizon, right? We're investing for like 2030 and beyond, right? As far as I'm concerned, there's another election in 2028, and I certainly plan on still owning Tesla in 2028, no doubt. So anyways, and I think, and I'll conclude with this, another point is, 87% of US Tesla drivers say they'll buy another Tesla, and this is people commenting on this on Reddit, and Reddit is not exactly known for being a conservative platform, so you got a lot of repeat buyers, you got a lot of people who are coming up on the term on their lease who are renewing, and so that could sustain Tesla if they had a bad few quarters or a bad year. But I think the bigger story is Teslas will drive themselves. Other cars won't. So if Teslas drive themselves, and if, Kias don't drive themselves, I think people will choose the cars that drive themselves. That's point number one. That's the bigger story. Robotaxis will drive themselves too. That's the other bigger story. The launch is happening in June in Austin. That's a big deal. There's a societal trend. Younger people are not getting driver licenses. They'll get cars that either drive themselves or they'll get a cyber cab everywhere that just drives itself. This is longer term, but this is, in my view, still happening in a visible time horizon. Then, Tesla Energy. Tesla Energy is the forgotten story. It is growing very fast, showing triple-digit growth numbers. And I really don't think an utility is not going to get a Tesla product because of considerations such as, he's on the Doge committee or anything like that. That's a bigger story, and of course, Optimus is a forgotten story. So So the Tesla story, in my view, is nowhere near broken. This is short-term news cycle. It's tough to go against the short-term news cycle. I get it. But this is nonetheless what I think. And I think Tesla is a steal right now. This was not financial advice, not investment advice. This is just entertainment. Hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching and have a wonderful, wonderful day.